Good afternoon. It's Robert and Julia Miller with the J. Patel Group and Rethink Real Estate with another exciting real estate update.
Exciting.
Are we on episode 104?
104.
All
yes,
right.
we are. Yes.
All right, moving right along. Please like and subscribe so we can continue to grow our viewership.
We were going to be talking about what to do with those HELOCs and second mortgages that we talked about last week, but we got a little more information on 2-1 buydowns, 3-2-1 buydowns, 1-0 buydowns, something new that we found out about. So we want to kind of go over that since we've been talking about that a little bit and kind of better explain those.
What is a rate buydown? Is it an arm?
No, it's not.
We'll explain the difference.
We'll explain the difference. First, we'll do jokes and history and regular news first.
Right. We'll also have rates and we'll wrap it up with inventory.
Right. All right. Let's see if we can stay on track.
Lay it on us.
Joke of the day. The biggest joke on mankind is that computers have now started asking humans to prove if they're a robot or not. It is, right? I mean, a dumb robot button. Prove you're not a robot.
Yeah, I love that commercial. I think it's a Geico commercial where the robot is trying to fill out the... Does that look like a stoplight?
Yes, exactly. I don't know if that's a stoplight. It kind of looks like a stoplight.
Oh my gosh, that was a good one.
Yeah.
Okay, so I took my daughter to work on Take Your Daughter to Work Day. Introduced her to everybody. We were all gathered together and she started crying.
Oh.
I said, "What's wrong?" And she said, "Where are all the clowns you get to work with every day?"
That's a terrible joke.
Having a bad day? There we go.
Yeah, that's terrible.
All right, moving on. A little bit of
right,
history for this week. 2003, dictator Saddam Hussein is captured December 13th, hiding in a hole near Tikrit, Iraq.
Yes.
They'll call that a spider hole. 1966, Walt Disney dies December 15th in Los Angeles at the age of 65. Very young.
Walter Elias, that's
correct.
Walter Elias Walt. And he died of lung cancer.
Yeah, he was a heavy smoker. So,
yes.
Yeah.
And Robert read that and I said, oh yeah, I wonder what he died of. And then found out what he died of. And then I said, oh yeah, he smoked like a chimney.
A lot of pictures, a lot of the pictures you see him in, he's got a cigarette in his hand.
Yeah. Well, smoking was highly sensationalized.
It was socially acceptable.
Very
acceptable.
In order to hang out with your friends.
Before we knew the extensive dangers involved.
Yeah.
Okay, 1938, workers break ground December 15th on the Jefferson Memorial in Washington, D.C.
And we've been to the Jefferson Memorial, right? Or have we not?
I can't say for sure.
We've been to Jefferson's house, Lincoln Memorial.
I'm not sure.
Yeah.
I'm not sure we've been to the Jefferson Memorial. Okay, 1903, the Wright brothers make the first powered flight December 17th near Kitty Hawk, North Carolina.
We have been there.
We have been there. Great place to fly a kite.
Oh, man.
The winds are amazing.
Windy. Yeah, but really fun. Fun to climb up in the lighthouses, too.
Right.
So high.
We discovered our daughter had a fear of heights. We had no idea.
Yeah.
Until we looked down and she's trying to get hold of the kids, but she's on her hands and knees against the wall of the stairwell.
Like, what is wrong with
Heather,
you?
What are you doing down there? And then we realized, oh my gosh, she's having a...
Get the kids. Make sure they're against the wall. I'm like, they are.
They're good, but we'll watch them.
We'll watch them.
Yeah, you never know.
Oh.
Okay, 1877, on December 15th, Thomas Edison receives a patent for the phonograph. Amazing man.
Yes.
Finally, 1773, colonists dumped tea into the Boston Harbor December 16th to protest British taxes.
That's right.
And I just finished reading 1776 by Dave McCullough. Excellent history writer, makes it very interesting for those that feel history can be dry and boring. He makes it very interesting, so highly recommend.
And when you go to Boston, they have reenactment things that they'll do, kind of a play type thing that they'll set up and you can be involved in. I want to do that. That's on my bucket list.
All right.
Yeah.
Okay, moving on to a little bit of news this week. The Fed hike expected at its meeting tomorrow, December 14th. The Federal Reserve is expected to hike baseline interest rates by 0.5%, down from the 0.75% hikes made at each of the previous 4 meetings.
Right.
One of the other important data points that was released today, and it had an immediate spike on the market, but then it came all the way back down again, and I have not dug into what happened, but it was short-lived. But at any rate, the CPI, Consumer Price Index, thank you, came in for November at 7.1%, so that's down from 7.7% in October. And then
that's not a good thing, right?
That is a good thing.
Oh, it's a good thing.
We're trying to get the inflation number down. So.
Well, I know, the inflation number down.
Yeah, and the core CPI for November was 6%, and that was down from 6.3%. So that inflation number continues to drop and drop and drop, and that's the whole purpose of the rate hikes. Okay, housing news. Rates have dropped too. I'll bring you up to date on those in a little bit, and they did tick down again.
Yes,
so that's kind of a regular occurrence here.
Really good.
Mortgage rates have tipped lower in recent weeks after climbing to a 20-year high in October and November. Existing home sales have dropped for 9 straight months. Demand has tumbled, but supply is low. So that's a good thing. It's be a major problem if supply was sky high and there was no demand. That would be a crash, which is what we had in 08. But that's not the case. Supply continues to be very low. Prices have fallen but are still well above pre-pandemic levels. Forecasters disagree over where the market might go next, and I think primarily
there's some variations.
Mostly to do with time frame.
Yes.
Is it going to be
first quarter, end of first quarter, or beginning of second,
or at the end of the year? We've heard,
we've
heard all three.
Yeah.
We've heard first quarter, beginning second quarter. We've heard 6 month or after 2 quarters, and then we've heard it's going to take all the way into next year. So we'll see which guru is correct. We'll continue to follow it for you.
Yeah, we've been listening. We've set in on 3 different ones now, so we're trying to get kind of the barometer of things and how other people's crystal balls are looking for them. Yeah, so.
Okay, builder bailout. Unlike homeowners who are reluctant to leave their low interest rate mortgages, home builders carry no such baggage. If they need to move inventory, they can cut costs and negotiate with suppliers. They can also lower housing prices. In November, 36% of home builders reported lower prices and 59% offered sales incentives.
They have.
Considering the rate buydowns is probably one of the most promising.
Quite a bit, yeah.
And I did note that Dave Ramsey says December is the best time to buy a home.
Yes, he does.
Far less competition. Builders are very aggressive because the number of shoppers is very low, and they're coming to the year end to clear their books. So. Not everybody wants to go shopping for a home during Christmas, but you can save yourself a lot of money if you do. So.
Right.
All right, moving on to regulatory news. This is a new one on me. I hadn't heard this before. Dot plot thickens. Along with the expected rate hike, the Fed's proverbial dot plot is also due December 14th. What is the dot plot? It is a graph of each Fed member's thoughts. The dots often have the biggest immediate impact on markets. So
have you ever made a dot graph of your thoughts?
I'm sure there's specific questions that each one of them receive,
Right.
and they put their dot on where they think that
They
answer's
must
going
have
to
to
be.
grade it
And then
in
they
some
put it into a
fashion.
graph form and they see, okay,
Right.
who thinks what's going to happen. So, interesting.
I guess it's kind of like what we're doing when we're talking about, we're looking at and talking to different gurus on their thoughts for the new year. It's kind of like this, it's what's
Kind of
their predictions,
Right.
what's their optimism level, and
Compared to this person
Compared
and
to-
this person
yeah.
and this
Yeah.
organization. So, yeah, I get it.
interesting.
A Wednesday press conference with Chair Jerome Powell will provide a venue for the Fed to discuss reactions. So we'll see how that goes. Council caution, we've talked about the problem with affordability probably since we've been doing this vlog. I think. So it continues to be a problem ongoing, and with the recent increase to the conforming loan limit, it's only exacerbating it. So the Housing Policy Council, HPC.
HPC, Housing Policy Council.
I threw you a curveball
You
there.
did, yeah.
The Mortgage Industry Trade Association warned that the FHFA's conforming loan limit for 2023, which we talked about last week, $726,200 and $1,089,300 in other high-cost areas, exacerbates the affordability crisis and makes urgent the need to address the dominance of government backing in housing finance.
So FHFA is Federal Housing Finance Administration.
Good job. Proud of you. So again, we're just going to have to continue to figure out ways to make housing more affordable.
Yeah, because those numbers just keep climbing. Okay, so we'll just move up the loan limits, because housing prices are holding steady. That's one of the things that the gurus were talking about.
All right, let's jump over to buydowns.
Okay.
What
let's
is
talk
a rate
buydowns.
buydown? Essentially, there's two different versions of a rate buydown. You can do a permanent, which is for the life of the loan, and you can do a temporary. The permanent buydown can be bought by the buyer. The buyer can buy his own buydown. He cannot buy a temporary. The temporary has to be purchased by either the seller, an agent, or what's the third one? Who else can buy it? The bank, right? The builder. The builder. Can offer it.
The bankers are doing some of it.
Yes, we have seen a little bit of them using that as an incentive, but mostly it's builders leading it. Real estate sellers. Sellers, I would say, number two.
And that's primarily what we've talked about it. In regards to is, an incentive. Instead of lowering your price, you can offer to do a rate buy down, 2-1 buy down, 3-2-1 buy down. So those are things that we've talked about it. But keep in mind, as a buyer, you can do it for yourself, some of them. And that's what Robert's going to clarify. There is a permanent one, that's the life of the loan. You've already said that. And then there's a temporary one. I didn't realize there were two separate ones. So
yeah. And how does this relate to an ARM? Not at all.
Not at all.
An ARM is an adjustable rate mortgage that you get that basically you're paying interest only for a period of time on your loan, and then after it indexes, 7-year, I think is most common.
Yeah, 7-year.
After it indexes, you go back to a normal conventional loan where you're paying principal and the current mortgage rate.
I think I saw like a 10-year as well. Yeah, I think I've seen 10-year, but
they're variable, but they have nothing to do with rate buy down.
Right.
So
Right. Okay.
Okay, so for an example, say you have a 2-1 loan buy down, okay? So the seller must pay the buy down because this is a temporary buy down. So an example would be, say you have a 6% loan rate, so your mortgage payment is $2,000 a month. Year one of a 2-1 buy down, your rate is only going to be 4%. So your monthly mortgage payment for that 1 year is going to be $1,500 a month.
Nice. Okay.
Okay.
That's good.
The second year, it's going to go up to 5%.
Okay.
Okay, so your mortgage payment will then increase to $1,800. It'll still be below the full $2,000 a month with a no buy down 6% loan.
So you got a budget
So
well
you're going
for
to
that
save
second
$200, and then the year 3 it'll go back to the regular rate of 6%, and from that point on you'll continue to pay $2,000 a month.
And I, as the borrower, can refinance anytime during this, right?
Exactly.
Okay, so if rates improve, then I can always get out of that.
Now, one thing to be aware of when we're talking about discount points, a discount point doesn't equate to a percentage point of a loan.
Yeah,
It
I always
varies.
thought it did.
It's a market fluctuation daily.
Okay.
So you can hit a low point where it's equal to 0.5%, you know, or it can be 3/8, a quarter even.
Who
You know,
knows?
you just
Yeah.
got to kind of try to hit it with your work with your mortgage provider to hit that at the lowest possible point. But
Okay.
on the rule of thumb, a discount point is usually worth about 0.5%
Okay.
to 3/8%. Now, the interesting thing is when you move to buying down 2 discount points, you don't get an equal amount. It's usually about half of that. So if buying 1 point down gets you a 0.5%, buying 2 points down is going to get you about 1/4%.
Okay. All
So-
right. That makes sense. I
So
get it.
you're buying you have a 6% loan, and you're going to buy 2 points down. On average, you're going to get it down to like 5.25. Okay, maybe 5 on a
Okay.
good. If you catch it at a good time, maybe a little bit more.
Okay.
So just definition, I love her definition on this. A temporary buy down is when a party in a mortgage transaction pays a lump sum in order to reduce the interest rate temporarily for early years of the loan. So it's always at the front end.
Right.
Okay.
Okay.
For instance, Melissa Vasileva at Bay Equity, she has 2 options, a 2-1 temporary buy down.
Okay.
They also do a 1-0 temporary buy down.
And I had
So
never
it's-
heard of this.
it's simply for a year.
For a year.
And again, these are temporary, so they have to be paid for by the seller, builder, or the agent. A
Okay.
borrower cannot contribute directly or indirectly towards a temporary buy down.
Ah, okay.
Now,
That's interesting. I wonder why not. But
I
we
don't
won't
know.
worry about that. We would
It's
ask that
probably a
of,
complicated
Melissa, I guess.
conflict of interest, so we would have to be diving in deeper than what
Yeah.
we do here.
Yeah, we won't.
What we do is more surface level. So I popped in on a class this morning, actually, on rate buy down, and the permanent buy down is for a buyer planning to never move again.
Ah.
Okay, because you
Right.
have to look at how long the payout is. So if you do a permanent buy down, the 1 point, as we said, is going to it's going to cost 1% of the loan amount,
Ooh.
whatever that loan amount
Could be
is,
quite a lot, yeah.
and it's going to get you about 0.5% off the rate.
So if I have a
Okay.
$400,000 loan, let's just say, it could cost me $4,000.
Right.
Whew.
But you're going to get 0.5% off the rate for the life of the loan. Remember,
Saving me a couple $100s a month, so
Right.
that's good. Okay.
Yeah. And it can be, you know, if you measure it out over, you actually hold that loan for the amount of money, it can be $15,000, you know,
Yeah.
as an example. So
Yeah. Okay.
it can be worth it in that case. But the rule of thumb is that the return on investment needs to be about 3 years or less for it to make sense.
Okay. So $4,000.
Unless you're planning really going to just, this is it, this is my home, I'm going to stay here for the rest of my life, I have no intention of moving. Nobody's
So if it's
getting me out
$200
here.
a month that it's saving me, so that's
It
12 months,
multiplies
28.
out. And,
$2,400 a year.
mm-hmm.
So 2 years.
Yeah, 15. Okay, let's move on to temporary rate buy down. This would be for somebody who intends to sell, say, within 3 or 4 years,
Okay.
or to refinance.
Growing family.
You know, they
something
think
like
the
that.
rates are going to come down in 3 years or so they'll go ahead and do the temporary rate buy down, and then at the end of it, they'll go ahead and refinance, or they're moving. And there's a
Growing
few
family or shrinking family.
Yeah, there's a few
You're right.
scenarios. So. Again, the cost of the buy down is always based on the loan amount. Sellers being asked for a 2-year buy down could counteroffer You could
Sure.
say, you're only going to get a little bit and it's costing me quite a bit of money. I'll give you a 1-year buy down. Or say they're asking for a 3, I'll give you a 2-year buy down, but not a 3 or a 1 instead of a 2.
And then in that scenario, the buyer couldn't pay for the other year, though,
No,
right? Because
well,
it's a temporary buy down.
No, but there is a scenario where they could do something similar, and we'll get to that.
Okay.
Again, this is the best option if the buyer does not plan to stay long term. Again, buyer cannot pay for this temporary buy down. Buyers can do both. Okay, so the buyer could buy themselves a permanent buy down.
Okay.
And they also could ask the seller, or maybe the builder's offering it, for them to buy a 2-1 or a 3-2 buy down. So they could do a combination of that. That is an option.
So, okay, in my $4,000 or my $400,000 purchase, and I buy down for the life of the loan, I get 1% of the loan, so 1 point gets me from, let's say, 6.5. Let's just make it 6.
Yeah, make it simple, 6.5.
So it brings me down to 6.
You're at 6, so you go down to 5.5.
Okay, 5.5, and then I ask for a 1-year temporary buy down from the seller as well to bring me down a little further.
So your rate would be 4.5 for 1 year.
Nice.
And then the rest of the loan, it would be 5.5.
That's not bad.
That's not bad. That's a pretty good savings.
Okay.
That was a good example. Thank you.
Yeah.
Now, what happens to the funds? They go into an escrow account and they get distributed monthly. Okay, so if the buyer sells before the buy down is finished, that money left over, he does not lose it. It goes into the reducing the principal amount. Can't get it in cash, but say you're refinancing or you're selling the home, then that comes off the principal amount that you owe on the loan.
That's good.
So
now I will say, I think the word escrow there may actually be impound account.
Impound, I apologize.
Impound. No, that's okay. I just want to clarify.
Yeah, impound, you are correct.
I sometimes used to use that word incorrectly, escrow account. It's actually an impound account. That's the account that pays your taxes when you wrap taxes, and there's something else, insurance in there. You can pay your homeowner's insurance as well. Not HOA fees typically, but taxes and insurance. Wow, we are having a heck of a spam day today.
Okay, let's jump over to loan assumptions. Obviously, a question a lot of people are asking because there's people out there with 2.25 loans and they want to sell. Can somebody assume their loan?
Yeah.
Well, in some cases they can.
I hadn't thought about this, so this is great.
Yeah, but
let's talk about it.
There are some things that you have to consider. So first thing I want to look at, we want to look at a VA loan. Say there's a VA loan out there, very low interest rate.
Yeah.
He's ready to sell. So here is some information to consider.
Okay.
You are assuming the balance of the loan, not the purchase price. So in this day and age of equity, everybody has so much equity. You're only going to be assuming the low interest rate for whatever portion of the loan remains. And then you're going to have to either finance the other ones, you'll have 2 mortgages, or come with cash.
So if you're selling your house for $400,000,
but you've got your
and
loan
your loan
down
balance
to
is $200,000.
$200,000.
I, as the buyer, have to come up with the other $200,000. Somewhere.
Right.
My pockets.
Didn't you say 300,000 for
no,
the 400,000?
400.
Okay, yeah, that's correct.
Kept it even.
Okay.
Okay.
Now, let's jump over to FHA real quick. The thing to remember on an FHA loan is it has mortgage insurance attached to it for the life of the loan. So that can be pretty pricey, and you have to do the math to see if you, say, are assuming a FHA loan for, say, 3%, but you also have to pay mortgage insurance, which could be another 1.5%.
1 or 1.5%, yeah.
And you have to bring extra cash to cover the difference between the purchase price of the home and the current mortgage, or the current mortgage amount. It may not be worth it. The math actually may be better off for you to just take out another loan, even though it's a little bit higher, but you can always refi if and when interest rates drop down.
Okay, all right.
So,
Not sure it's worth it, but
now on the VA, ideally a VA seller wants to sell to another veteran, and then it will automatically move over to the buyer, and then there's no liability to the current VA loan holder.
do I have to be a VA? Oh, you're saying
You don't
if I'm a
have to,
veteran
but
as
that
well.
is the ideal scenario,
Okay.
because in order for it to transfer, there's a couple of concerns for the current holder of the VA loan.
Okay.
They're responsible, if it hasn't been released, they're responsible for the results of that loan. So
Ooh.
if they fall behind on the payment,
Oh no.
or they default, it goes against their VA benefit.
No, yeah, you wouldn't want that. Yeah.
So it's very important that it gets released, the release of liability during a VA loan assumption. So
What about my certificate as a veteran?
that's the
Certificate of
other thing
eligibility.
is, if you don't have this liability assumption taken care of, you may not qualify for your next home purchase
Right.
under the VA program.
Okay. Okay.
So during a VA loan assumption, the original buyer must ask and obtain the release of liability before the loan's closing. The original owner must fill and submit the VA Form 26-6381 to request the release of liability for the VA mortgage.
Right.
That way they're free and clear of it when they turn over title to the
Yeah,
home.
that's that eligibility certificate. Yeah.
And the warning, your credit score could take a significant hit if the new buyer defaults on the loan repayment
No,
without this release. So VA
Oh.
folks, it's very important that
Yeah.
you do that.
Okay. Yeah, that one doesn't sound as inviting.
Well,
Really, either one of them do, or
it-
neither one of them do.
it could be in certain circumstances.
Okay.
Melissa's been in the business 33 years. She said she's never done one. Of course, we're in uncharted times
True.
too.
Yeah,
so
these are special times that we're going through. We have to have, like you always say, dust off some of those old file types and plans and different things that we used to use or that were used. I haven't been in the business for 33 years, but yeah, that's interesting. Those are interesting options. Thank you.
There's also an option to be exempt from the VA loan assumption funding, because that is one of the requirements to assume a VA loan requirement. There's a 0.5% of the loan balance for a funding fee. So you can be exempt from that if you receive VA compensation for a service-related disability. You are
Okay.
eligible to receive VA compensation for a service-related disability. You receive compensation for pre-discharge disability. You are a spouse of a veteran who either went missing in action, was a prisoner of war, died in the line of duty, or from a service-related conditions.
Oh boy.
Any of
Okay.
those criteria will exempt you from the VA funding fee
Okay.
of 0.5%.
Again, if you've got questions, Melissa can help you get answers.
Right.
We
just
will
kind of scratched the surface a little bit there to give you a little basic information
Yeah.
on what's
let you
going
know
on
what's
there
out
and
there,
what-
what possibilities are out there, what's being spoke about in the marketplace that we are hearing about. And so, yeah, there's a lot of options out there that we haven't had before or haven't used in a really long time.
Right. All right, let's move on to inventory again.
You want to hit
it's-
the regular rates first?
Oh, I'm sorry. Regular rates. I'm sorry.
That's all right.
The 30-year has ticked down 6.541 down to 6.445.
Yeah.
15-year 5.893 down to 5.677. So they all continue to tick down every week. VA is now down to 6.211. So
Wow,
we're getting
okay.
down to the 15-year being well
Nice.
under 6%. I'd love to see the VA and 30-year get down to 6 or
Yeah.
maybe a little bit under 2. So
Okay.
let's
hope,
see.
Let's hope those lower rates hang in there through the first of the year.
Yes. All right, moving on to inventory. Again, as predictable for this time of year, Valley inventory continues to drop. Dropped another 480
Yeah.
units, so we now have 18,203 active listings in the valley.
All right.
Peoria dropped as well. They're down to 617, and Surprise is down to 854.
All right.
A little closer to home, Trilogy at Vistancia also dropped down. They're down to 37 now. 495,000 is the most affordable. 1,430,000 tops the list. Vistancia Village also dropped. They're down to 51. 429,000 the most affordable. 1,056,669 tops the list. And this is a David Weekley brand new home out in
North Point.
North Point.
Yeah.
So that'll probably stay there for a while because there's like 6 almost $1 million homes that David Weekley has available.
Ah, okay.
Let us know if you'd like to buy a couple of those. We'll be glad to help you.
Right.
Okay, Blackstone Country Club down 1. They're at 11. 575,000 is the most affordable. 2,790,000 tops the list. Portobello is flat at 33 available homes. 439,000 the most affordable. 929,900 tops the list. Sun City Grand actually ticked up a little bit. They're at 120.
Way to buck the system, Sun City Grand.
Yeah, 279,000 the most affordable, 999,900 the most expensive. Sun City West is sitting at 182, 205.
They came up a little too.
Yeah, they did. 205,000 the most affordable, 869,000 the most expensive. Finally, Westbrook Village has 40 homes available, 285,000 the most affordable, and 560,000 still tops the list.
Back to that tight price range.
Yeah, almost within
Oh,
300,000. You got 40 homes.
For 40 homes.
Trilogy at Vistancia sold last 30 days. Still sits at 7 homes. They I think we
Not
also
very
had
many.
16 under contract last week too.
Maybe,
so
yeah.
that is unchanged. Vistancia Village sold in the last 30 days, 7 homes, and finally Vistancia Village under contract, 11 homes.
11. Okay.
Okay, that was a lot of information.
Yeah,
So
yeah.
hopefully, if you have any additional questions, don't hesitate to reach out. You can call, text, email us. Feel free.
We will have some updates. We did our final Cromford report this week, and then we also did some other predictions. Lawrence Yoon with the NAR, he's a chief economist for National Association of Realtors. So we have his report to kind of share with you too. Well, as we move closer to the end of the month, we'll probably go over those. We've got a few other things to highlight before then. I've got a small water update to share on Lake Pleasant specifically. That's the Northwest Valley. Lake Pleasant is here in the Northwest Valley. It's been compared to Lake Mead, and there's some differences to talk about.
Okay.
And so, yeah, we talked about refinancing, and if you're going to refinance and do some home improvements, what home improvements you should consider spending money on.
Right. Some pay off 100%, others not so much.
Right. We will come to that more next week then, in the weeks to come.
Now, are we going to do a vlog on the 28th, or are we just going to have a holiday party? Or a special guest or something?
I don't know. Maybe we can do a special guest.
Yeah, we'll see.
Yeah, we'll see.
Okay.
Who knows?
All right, that's our report for this week. Everybody have a blessed week. We will see you again next week.
See you
Take
then.
care.